Hi and welcome to Swissquote's Daily Market Talk. It's Friday, October 24th. Trade tensions wobble, optimism comes and goes on a series of now usual Trump news and earnings announcements, and crude oil stabilizes and the US dollar consolidates this week's gains ahead of the much expected and only official US data of the week and of the late, which is the CPI data. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. Okay, so trade tensions between the US and China ease after flaring up and easing and flaring up again over the past week and the past week. So news that this time, Trump and Xi Jinping will be meeting next week, next Thursday, to be specific, in a summit in Asia, even though that optimism tamed since then after Donald Trump said in separate talks that the trade talks with Canada are now terminated immediately due to an ad against the US tariffs there targeted at Republican-held districts using the words of Reagan. So there is no guarantee that the meeting between Trump and Xi will happen, or it will lead to a durable truce between the two countries. I'm actually extremely skeptical on that end, but if it happens, it will be the first face-to-face meeting between Trump and Xi since Trump returned to the White House, and the meeting will obviously follow a wild ride of tariff and chip war between the two countries that only kept building since January. Now, make no mistake, Xi Jinping knows very well that America won't be the ideal partner for China with or without Donald Trump in the White House. Because look, the relations were not this hectic, but the first chip export restrictions came under the Biden administration. Well, the trade war is going on since the first term of Trump, but the things have not gotten better with Biden. And China is now decided to gain its own technology independence from the West for good, and they're doing quite well on that end. They have their own technology giants, their own social media platforms, their own communication systems. They build electric vehicles, smartphones, robots, and chips, and you name it. And they now want their technology giants, Alibaba, for example, to use their own homegrown technology in China and chips to keep things in-house. So in the light of these latest developments in technology, NVIDIA CEO Jensen Huang was smart enough to warn everyone that not selling chips to the Chinese would encourage them to make their own chips and make it rapidly. So that's exactly what is being happening right now with many local chip makers in China. Among them, SMIC, for example, soared nearly 500% since last September, and Alibaba, which is now the poster child of the AI play in China, gained up to 140% since DeepSeek's chatbot hit the ground at the beginning of this year. And the Hang Seng Index in Hong Kong recovered about 2/3 of post-2018 sell-off and has room to run higher from the actual levels given the limited exposure of foreign investors in Chinese technology market, which means that they could invest more money here, and the Chinese government's determination to make the Chinese technology sector shine brighter. But anyway, coming back to my trade story, the two leaders, Xi Jinping and Donald Trump, will meet next Thursday, and the latter could keep hope and eventually the bears away, at least for now. And elsewhere, prospects of robust technology earnings and lower Federal Reserve rates also help keeping investor mood sweet at the moment. Although the earnings from some technology names in the US and in Europe this week have been quite mixed, including Netflix, Tesla, IBM, Supermicro, ST Microelectronics, and SAP. Well, the expectation that the AI-related technology giants like Google, Microsoft, and Meta will be smashing it from next week keeps the market in a wait-and-see and quite a hopeful mood. On the Fed front, on the other hand, the Fed is expected to announce another 25 basis point rate cut next Wednesday to prevent the US jobs market from further weakening. Now, we don't know if the US jobs market kept weakening last month, given that the US government remains shut and the US economic data is now very much scarce. But the Bureau of Labor Statistics actually decided to publish the September CPI figures today to give at least a little indication, a little idea to the Fed and to investors and the market about where the price trend stands in the US before next week's Federal Reserve decision. Now, both headline and core inflation numbers in the US are expected to land somewhere around 3.1% level in September year over year, and the price pressures could actually push the CPI up to 3.5% in the coming months, according to some, given the tariff-led price pressures. Now, that is obviously well above the Federal Reserve's 2% official policy target and moving farther away. But there is now a broad conviction among investors in the market that the Fed will actually tolerate higher inflation to prevent an economic meltdown in the US. How high? Time will tell. But if you watch that episode, well, Glenn Coxon of NFG Partners said in our latest quarterly market outlook that the Federal Reserve probably shifted its inflation target to 3% without telling anyone. But even with the heightened tolerance for inflation is an issue. It will probably remain one. So today's numbers are not expected to be a game changer, mind you, for next week's Fed decision if they align with the 3% expectation, and even not actually. A number less than that will sure spark expectations that a third interest rate cut from the Fed would be coming in the December meeting and boost appetite in risk assets while also pulling the US yields and the US dollar down. Whereas a set of stronger than expected CPI figures from the US today could actually lead to a certain readjustment of the dovish Federal Reserve expectations and add to the hesitation regarding whether the major global indices actually deserve to travel through uncharted territories. Because look, the rate cuts are originally meant to tame economic pressures. But looking at the index level, well, global indices don't look sad at all. In the sense, the S&P 500, Nasdaq print record after record. Yes, that's mostly due on AI appetite. But the Dow Jones Industrial Index in the US is also near its all-time high levels. Then the same applies to the Japanese stocks and the European Stoxx 600 Index, despite mixed earnings there, and the FTSE 100 Index as well. But yes, indices don't necessarily reflect the underlying economic fundamentals. We now know that. And in an environment full of inflation risks, well, stocks may actually help to keep up with price pressure. So for now, and despite the bubbling bubble worries around the technology stocks, the consensus is the extension of the global rally. So let's see if the US inflation data supports or challenges that view before the weekly closing bell today. And in the absence of big deviation from the expectations for the CPI figure, well, investors' focus will mostly remain on earnings and the Fed from next week. So in the FX markets, the US dollar was well bid this week, actually much better than what was expected to happen given the extended government US shutdown of the moment. But the political news elsewhere will actually counterweigh the dollar's weakness right now. So in this international context, the French political chaos and the latest rating downgrade from S&P kept the euro under pressure this week, while Takaichi's appointment as the new Japanese prime minister keeps pushing the dollar yen higher these days on expectation that she will be pushing for a softer Bank of Japan policy, and she has no problem further weakening the Japanese yen. In the metal space, while gold consolidates a touch above the $4,100 level this morning per ounce, hinting that the early week selling pressure in gold is probably over, with the volatility also easing here. And in the energy space, US crude tested but failed to extend gains above its 50-day moving average that currently stands near the $62.5 per barrel level on major sanctions targeting two Russian oil giants that led to multiple contradictory reports on the wire on whether India, for example, would stop buying Russian oil, fearing secondary sanctions or no. From a technical perspective here, the latest news have run their upside potential, in my opinion, and minor correction in US crude prices could be on the menu of the last hours of the trading week. So this is all for today and this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.